Hello, good afternoon, everyone. My name is Erin Campbell. I am the Research Library Manager at CIPR. Want to welcome you to today's CIPR Journal Club. The Journal Club is a new offering for us this year. The intent, like much of the work that we do, is to help facilitate understanding and conversations, dialogue between state insurance regulators and folks doing research in this area. Our last Journal Club session was this spring, and we covered an article on surprise medical billing. A recording of that session is available in our library catalog, which you can find at library.naic.org. Today, we are covering a recent article from our journal called Flood Insurance Redesigned, Regulatory Considerations for a Viable and Sustainable Private Market. Hopefully, you've already had a few minutes to take a look at the article prior to today's call. There is a link to the article in the chat for easy access. So the plan for today, if you haven't been a part of a journal club, the idea here is just basically like a book club. So for the first about half of today's call, we're going to take kind of a high-level look at the article, kind of led by my CIPR colleague, Brenda Rourke. And then we will get to hear from two of the article's co-authors. We're lucky to have two of them with us today. Then we'll split into breakout rooms. We've got a really good group of folks here, so we're going to split into some breakout rooms to have kind of some smaller group discussions. A member from the CIPR team will be in each room to help facilitate kind of some guided discussion. Here, we highly encourage you to turn your camera on if you're comfortable with that, unmute yourself, and join in the conversation. Share your thoughts with your group. We will close the breakout rooms with about 10 minutes remaining and return back to the big group for some closing remarks. And one other little bit of housekeeping before we dive in. CE credit is available for today's session for participants who attend the full hour. Certificates will be emailed to you with the email you used to register from the NAIC's Education and Training Department within about 2 weeks or so. So watch your inboxes for those. And so with that, I'm going to turn it over to Brenda.
Okay, great. Let me just get my very short slide presentation up here for us so we can kind of just walk through some of the high level points that I wanted to highlight before we jump into our discussion groups. Again, I wanted to thank our co-authors for being here with us today. We have both Rebecca and Laura Lee here with us today to discuss the article. They'll be coming into some of the discussion rooms that we have set up to talk about the article with us and answer some questions, and we'll do a little bit of that at the beginning as well. But before we jump in, a little bit of background. I do not have a depth of knowledge when it comes to flood insurance. That's not my background. I'm actually a communications scholar. So I did a little bit of work on my own to kind of familiarize myself with this area. And I found some really interesting Pew data that shows that between 2000 and 2021, that at least one flooding event was reported in the country 8 out of every 10 days. And I think that, sort of tracks with what we're seeing currently in the headlines regarding flooding. Most recently in Vermont, there was some catastrophic flooding. So that wasn't surprising to me to find. In looking at the article, I kind of broke this out into the 5 sections and just had some key points that I wanted to look at before we, as I said, jump into those discussion groups. In section 1 of the article, they kind of introduce the problem that's here that exists, and that is that, and this is coming directly from the article, despite the risk, most property owners do not buy flood insurance, leaving the vast majority of U.S. properties uninsured against flood. This tiny flood insurance penetration is set against a backdrop of significant and increasing U.S. flood risk. And in the face of this increasing risk and market opportunity, financial challenges exist within the National Flood Insurance Program that lead to uncertainty regarding its long-term viability, as well as its capacity to keep up with changes in the likelihood and impact of flood losses. And based on that Pew data, this likelihood is pretty high. In section 2 of the article, they talk about the need for this private market. In the case of US, and again, this is coming directly from the article, in the case of US flood risk and the long history of coverage by the National Flood Insurance Program, even government representatives at the federal and state level are concerned about the far-reaching economic implications of continuing to be the market of first resort, and they are seeking out private market strategies. So this really expresses the need for this particular market. In the third section of the paper, they talk about some of the opportunities and challenges in developing this product, right? The complexity of insuring flood risk and some of the challenges that exist there. In the fourth section of the paper, they dive into some policy making and some key features that they think need to be included there. And I looked at that kind of as a framework, and they focused really on flexibility and how that flexibility would encourage private insurers, protect their solvency, as well as protecting consumers. And then finally, they wrap up with some considerations and implications for a flood insurance market that is not the market of first resort for the National Flood Insurance Program, but rather is supplemented by the National Flood Insurance Program. So with that, I'd like to hand it over to our authors to kind of share some of their thoughts about the article and open it up for anyone to ask questions now before we go into those discussion groups.
Rebecca, do you want to go first or you want me to go?
I'll just introduce you, Lori, and then I'll let you take it over if that works. I'm Rebecca Williams. I work at the North Carolina Rate Bureau. And for the North Carolina Rate Bureau, right before the pandemic, we developed and filed a flood program here for the state of North Carolina. In North Carolina, for property insurance, all types of residential market property insurance have to be using the same policy forms and the same rates, which makes it a little bit challenging in North Carolina. As a result of all of that work that we did, Laura Lee and her team at App State decided to take that and run with it. So they used some of the resources from the group that I was working with, as well as, others across the industry who had knowledge of the National Flood Program, et cetera. But really, most of this should be credited really to Lori. And so with that, I'll turn it over to you.
Oh, goodness. So I'm going to shoot that right back at Rebecca and Dave Evans, who were co-authors. What I can share as backdrop, which I think is important in describing sort of the impetus or the genesis of this particular article, is that I work with and lead a group at App State at the university where I am called App Rise. It's a risk initiative for student engagement. And because I guess really probably triggered more by Hurricane Florence than anything else, we had a real interest as a group in studying flood insurance and the potential for privatizing flood insurance. And so I and a group of my students in 2018, 2019, researched and then developed a fairly extensive report on privatizing flood insurance in the US and different ways of doing it and what makes sense in different places. And it got good traction within North Carolina with the independent insurance agents and with the Department of Insurance. We found out then that Rebecca and her team at the Rate Bureau meanwhile, they were in the process of developing a flood insurance program. And so a colleague of mine, Dave Marlette, and myself, we undertook an evaluation of their program separate from the more general study I had done with my students. Dave Marlette and I evaluated the North Carolina flood insurance program and were really favorably impressed with several of the features and some of the things that we saw that they had done that were aligned with what my group at App State had really suggested, like the flexibility of the program to respond to different types and different levels of risk and different types of regulatory issues. We were, in short, favorably impressed with the program. And from that, I started to develop a paper and asked Rebecca and Dave Evans, who had participated in that North Carolina flood insurance program development, if they were willing to join on the paper. So on the paper is a former student who now works with Gallagher Re, a former student, Catherine Lattimore, who was the student lead on the project we did around U.S. flood insurance, who's now been in the industry since 2019, and Dave Marlette, a colleague at Florida State, at App State, as well as Rebecca and Dave Evans, who both participated very, very extensively in the development of the North Carolina flood insurance program. So this all sort of came together as a broader look, but based on a common interest the five of us had in flood insurance and in the North Carolina program in particular.
Great. So we have a few minutes here if anyone wanted to ask any questions before we go into our discussion rooms.
I have a question. This is Kelly Edmiston from CIPR. One thing that struck me in the paper is that in several places there were statements like, we assert that if a viable private flood market risk market can be established. So there, so the key word be if. So are you all, would I be interpreting that properly if I said you all aren't convinced that this market can be created, expanded, maintained, or do you have some certainty that maybe it could be?
I'll answer first, and then I'll let Rebecca address from her standpoint as well. I'm a big believer in private markets. Whenever it's possible to have private instead of public market for a risk, I think that it makes good economic sense to have a private market. So I'll put that out there as sort of my lead to the rest of what I say. But I do think that, sure, there are questions around participation, whether we can get the take-up rates needed in quickly enough, take-up rates from customers, from potential policyholders quickly enough for markets to establish and stay established. I'll also mention that when we started this paper, we were still very deep in COVID, and insurers were not signing on in the numbers that they have since. So some of the wording you see there too is very much because we were in COVID while we were writing the paper, and we just weren't seeing a lot of interest from insurers, understandably, because they had bigger fish to fry at the moment. They were very concerned about getting through COVID period and not necessarily about creating new products that they weren't already working on previous to the start of COVID. So I think from my standpoint, yes, I believe in private markets. I have a favorable view of the viability of privatized flood insurance markets, and in collaboration, particularly with government markets as markets of last resort.
Thank you.
Rebecca, we can't hear you. I don't know if you're.
I turned myself on mute and then started talking. So sorry. So I was just starting to talk about some of the hurdles that we have in private flood insurance markets, and the fact that for flood insurance in particular, it's not just regulatory hurdles, although that is one and can be significant in some states. But also, there is a hurdle, as Lori said, with the take-up rate and people recognizing that there's a need for flood insurance. So it hasn't been, something that's been widely accepted and sort of seen as needed across the board. There's also very much adverse selection. If you've got a high flood risk, you probably know it. You've been in one of the traditional flood zones. But not everybody recognizes that everybody could be in a flood zone. Sometimes it just depends on where it rains. The federal program has some nuances and some challenges. But one thing that we have been pleased seeing out of the FEMA program is that they are advertising just not get flood insurance from us, but just get flood insurance, right? And so that's one of the ways that really the backstop of the federal program is trying to assist in the private market, recognizing that in some cases insurance carriers, because of the economics, can charge less to those lower risk policies because of some of the requirements and the subsidizations that go into that federal policy.
I have a question. This is Gennady Stoliarov II from Nevada, and it's interesting, by the way, in my interactions with the NFIP, I haven't observed any sort of aversion to the emergence of private flood insurance. My impression is the NFIP sees it as complementary to its own program and perhaps able to relieve some of the pressure on the NFIP. But what's interesting to me is that it really took about 90 years to get from kind of the Mississippi River flooding of the 1920s that convinced much of the private insurance market that flood was an inherently uninsurable peril to this situation where tentatively there is beginning to be more of an offering of private flood insurance. And I wonder what your thoughts are on kind of the dynamics that cause the entire industry to perceive these insurmountable challenges, because what worries me is a similar dynamic may be starting to take hold with wildfires, particularly in light of recent events in California, and what could be done based on the lessons in the flood space to kind of prevent this widespread perception that this is too large of a peril, the risks are too interconnected for the private market to viably insure it, and there needs to be some sort of overarching governmental solution. Of course, once we have an overarching governmental solution for decades, then it comes to be accepted knowledge, at least the perception comes to be that way, that this is a peril that can only be insured by a government program. So I'm curious with regard to your thoughts on that. How can we maintain robust insurance markets, private competitive markets for these other perils like wildfire, which may become increasingly prominent over the subsequent years?
Yeah, thank you for that question. Rebecca, do you want it? Are you good with me going first? Or you?
Go ahead. Go ahead.
Okay. She and I communicate really well when we're by ourselves. So in a big group, it's a little bit different. But no, I do appreciate the question. Looking at flood for a minute and just thinking back, doing sort of the backward analysis at that time, during the time period that you mentioned, 90 years ago, we were really without sophisticated residual markets for the private industry, the private sector at that time in insurance. And so the private sector was sort of I don't want to say all or nothing, but it was a much different market dynamic at the time without the sophisticated residual markets we have today. Another huge change since then has been the sophistication of risk assessment, particularly in flood risk in recent years, and the sophistication, improvements in the technology for doing more accurate risk modeling. So both risk assessment and loss modeling have improved tremendously just within the last 10 years. So I would say, a big change we saw slowly over that whole 90-year period was advancements and sophistication within the risk financing system itself that sort of allows for more collaboration than what insurers could have expected at that time, but also just in the last 10 years or so, much more quickly advancement in risk assessment and risk modeling. So I think that the same, now stepping away from flood and looking more broadly at any potential catastrophic peril, I think that those changes, those improvements in technology and those improvements in the sophistication of the overall risk financing system, and I mean public-private partnership opportunities, as well as the number of insurers and the size of insurers, I think all of those improvements make it much more possible today to continue to be robust even after there are significant losses, with the exception of something like a novel loss, something that you just weren't expecting. Certainly that could still prove to create big kinks in the insurance financing system. But short of a novel event or novel events, it seems to me that with the discipline that the industry can remain robust and have robust loss ratios, even ensuring catastrophic risks like wildfire. But the public-private collaboration is a big help to that.
Right. So my responses were very much in line with Lori's, that in flood, that the advances in modeling are one of the significant drivers that have gotten us to where we are today. The expansion of the capital markets and the fact that we recently have been in a time period where there has been more capital available. Now that may be closing some, but also climate change and the way that, we're building closer to the coast and making canals, and how construction and how people have moved more coastal, seeing states like Florida increase in population significantly, et cetera. Those are some things that maybe were not around as much because we didn't have as much of the technology available. So again, very much along the lines of what Lori said. When it comes to wildfire, while I don't know as much about them, certainly I think that having the capital markets available can impact and help in that space as well. And I think that, currently wildfires are being studied, but I don't know that, because there hasn't been a federal backstop, I don't know that data is as widely available. And where it is available, it might not be as specific as what we've been able to get on the side of flood, just because of the fact that we have had some, federal program in place for a while. So I think there are still some challenges and some hurdles in the wildfire space. But I do think that that's maybe in its infancy, maybe about where flood was 10 years ago. And I continue to see, at least in the actuarial space, more and more going on the topic of wildfires.
Thank you. And I'm definitely seeing a lot more wildfire scoring models being proposed with some increasingly sophisticated elements. So I appreciate those responses.
Okay, so I think
Go ahead, Brenda. Well, no, I just had a quick question regarding if a consumer was to purchase a private insurance plan, and then they would happen to be losing that plan for whatever reason, whether the insurer were leaving the market or would that put any stigma on the consumer themselves, or would that be a requirement for, would other insurers take that risk on that, property? Would there, I worry about the fact that with so many insurers leaving the markets today in certain states to cover these catastrophic risks, and this would be another one of those catastrophic risks, and then you're leaving individuals who have to go back to the backstop, perhaps. But just if that was even a consideration.
Yeah, so I'll start with this one, Lori, if you don't mind. Here, I think that it's about rate adequacy, really. If you're charging a private customer an adequate rate, then it shouldn't matter whether or not they have flood insurance. I don't feel like that's an indicator as much as the historic stigma rather, of you're in a flood zone or you're an A risk or an AE, that type of thing that existed historically. That's my gut reaction on that.
I would simply add, I agree with Rebecca's comment. I would add that, if there's a continuity of coverage concern, the regulators, I think in creating private flood market regulatory guidelines, it is key. And your question is a great one from the standpoint of consumer protection, but it is key, I think, that regulators be sensitive to that and ensure that insurers that are offering coverage in the space are offering coverage that would be seen as equivalent to or enhanced better than, if you want to put it that way, what's available with the NFIP. so that if an insurer did lose their coverage, their private coverage, that as a last resort, at least in the near future, the NFIP is still there for them to return to in case another insurer doesn't, that's offering coverage in that space, in that state, in case another insurer does not want to offer that coverage to that customer, that they would still have the NFIP as a resort.
Thank you.
So I have a question. So tracking as we've continued to discuss, and I apologize if you've hit on this, but as we've talked about the public versus the private market, one of the things that I've continued to think about, and it was hit on in the paper for the state of Florida, was looking at, is it, and maybe I guess I'm looking at your opinions on this matter, was similarly to other types of insurance, that is it feasible, or what are your feelings on mandating flood insurance to up the, whether it's in the public market or in the private market, for property owners to increase the to make sure that we those consumers have the product. And I know it was hit on already, that anyone these days could be caught up in, you don't necessarily have to be within the map, in the flood zone map, that it's potentially a good product to have. So I guess my question is, how do you feel about potentially what the state of Florida did with those that were in that had insurance provided by Citizens Property? Now I know they're kind of in their own mess right now in the state of Florida, but they did have that mandate.
Yeah, Jeff, thanks. Rebecca, I'll go first, and then I'm sure you can make really good comparisons between North Carolina and Florida that I can't draw with as much knowledge of it as you have. Jeff, I lived and worked in Florida for a decade. In fact, my research was dedicated to the hurricane problem, or the insurance problem, or the regulatory problem, whatever you want to call it, that Florida has experienced for years. And, it's a fantastic laboratory for risk, and I've said that for years. But Florida, with regard to hurricane in particular, so if we're saying hurricane-induced flood losses, which is, I think, at the crux of why they thought this mandate was important, in Florida in particular. If you look at that problem there is it. We could spend hours just talking about Florida and the flood risk and the hurricane risk. They are dealing with such complexity in Florida of what the problems, plural, are around hurricane and the potential for flood, that I don't, on the face of it, question their decision to create a mandate for Citizens customers to also carry flood insurance. There's probably some really good data to back up a need for that makes sense, just from what I know about the complexity of the problems there. More broadly, if we're looking beyond Florida, where, not to say that other states don't have great need for flood insurance, but just to say Florida is probably the most complex state that I can think of offhand where this might apply. But in less complex places that don't have all of these problems coming together at once, the way that Florida does, with assignment of benefits on top of their issues around just the geography, on top of the issues around political uncertainty, and how big Citizens is once again. But if we look at other states, I'm less convinced that they would need the same sort of mandate. But again, given it's Florida and the complexities of Florida that I myself experienced, both studying it as well as living there, I don't question it. I don't think that there's anything wrong with, on the face of it, wrong with pushing a mandate that would take pressure off of customers on the back end, take pressure off of policyholders and homeowners on the back end after a loss, and would reduce the confusion around whether they have coverage for the losses that they experienced.
So thank you, Lori. I'll speak specifically from North Carolina to some degree, but I feel like one of the things about flood is really the fact that consumers don't know they're in a floodplain, right? They don't know the risk of flood. And so there's really a pretty significant knowledge gap with most consumers. Everybody wants a house on the beach. I do. I don't have one though. And I don't have one in part because I do know the risk of flood. And I do know the fact that house on the beach is taking up maybe a great deal more risk than I'd be comfortable with. But I do think that even in North Carolina, for example, we've seen some strides in that area. When we were developing our North Carolina program, we saw realtors being very interested in learning more about what we were doing, et cetera. And then even earlier this year, there was a move to expand the disclosure of past flood losses in the realtor space. So I think it's sort of a problem that requires everybody working together. And in some cases, I think the requirements, whether it comes from an insurance company or a realtor in the sale of a house, I think those items are really going to help identify that flood is a significant problem. And it's not just a coastal problem, right? It is a problem that can happen anywhere. Like, you mentioned Vermont at the start of the call, and, what we saw in even Yosemite, our national parks, right? I mean, there's flooding can happen anywhere.
Okay, so if everyone's ready, we're going to go ahead and break out into some smaller groups for a little bit here. Lori and Rebecca will be or Lori and Rebecca rather, will be joining us in the breakout rooms to help stimulate our discussion and answer more questions for you. And then we'll join together back here at the end for about 10 minutes to have a little bit more Q&A with our authors. Thank you so much to everyone who's already contributing to the discussion. Erin's going to go ahead and put us in those breakout rooms and we'll kind of continue in there.
Connie, can you go ahead and move us into the breakout rooms?
And Erin, I'll stay on, but need to take off for a little while. This is Lori. In terms of just being available for breakout, I'll stay in the main meeting, but just mute and turn off my video.
Got it. Thanks, Lori.
Okay. What time would you say? Like
45
after, or?
Yeah, about 10 minutes, 12:50.
Okay. Okay. I'll be back. Thank you.
Thanks.
All right, everyone, welcome back. I hope you had lively discussions in your breakout rooms. I know that we did. And I was hopeful that everyone was having, as much of a lively conversation as we were. Now that we're back, we have about 8 minutes here or 7 minutes here left where we can open this back up to questions for our authors or just some thoughts about the discussions that went on in each of the breakout rooms. Feel free to jump in and participate in the conversation here again.
I'll jump in. I think we ran out of time before we ran out of things to talk about. One of the things I wonder about as we talk about private market flood, and it's been a little while since I've looked at that data, but my recollection is that the uptake for private market flood tends to be focused on commercial properties and or personal properties with an attachment point above where the NFIP is. But any thoughts? Am I not seeing the right data?
From the recent data I've seen, I'd say that's absolutely correct, at least in North Carolina. I will say that first dollar policies written by sort of our admitted market carriers did start showing some uptick in the residential property over the last couple of years. So we are starting to see more, but I will say historically, and our group talked about it as well, that it has been a surplus lines type of product in the past.
Yeah, I agree, and we're seeing that elsewhere. I think that's why the discussion is so important around how to design guidelines for these plans and how the plans can be optimally designed so that we can get take-up rates that are reasonable, that make the market viable. I think right now we're not seeing so far what I would call a fully viable private market for homeowners flood insurance.
So does the impact of the NFIP's glide path to rate adequacy, is that affecting how the private market is doing? I mean, if people move to the private market, then they lose that glide path, I believe.
I believe that's true, but I still think that there are significant pockets in the private market where today your policy in the private market would be significantly below what you could get at the NFIP.
I agree, and I think what we're seeing with the NFIP glide path and rating 2.0 is that more, and this is anecdotal, not good solid data, anecdotal data, is that would make a lot of the private market plans that are available more attractive to consumers, not less attractive right now. That the pricing, I don't want to say on average, but there is, as Rebecca said, there are a lot of pockets where the pricing is better in the private plans than it is in the NFIP, and continues to be true as they glide path to rate adequacy in the NFIP.
So the price, where the pricing is more attractive, does one assume that those are lower risk properties as respects flood?
It could be one of two things. It could be a lower risk property, or it could be a property who through the NFIP was, being averaged with higher risks where there was maybe more diversity in the train and the lines weren't drawn correctly. So I think there's, that's one piece of it, but I think there's other pieces as well.
So private market is improving granularity as well.
Yes.
Yep. Yeah, that's definitely the second piece, and I agree. Yeah, just the still better granularity in the private market modeling and pricing than there seems to be in the NFIP yet.
Hi, we had someone bring up in our meeting, I think it was Paula, forgive me, I can't remember exactly who, talking about bundling. Has anyone heard of bundling, like earthquake, flood insurance? If you watch the news, possible alien invasion, these extra type insurances. Has anyone heard of bundling those together for people?
I will say from my experience, you're the first I've heard mention that kind of possible policy.
Same here. That's a new one on me.
You know, it would
Interesting.
it would seem to be highly lucrative for an insurer to bundle alien invasion insurance with flood insurance, just charge like a flat $200 per year premium for alien invasion insurance. And I'm sure that would be a profitable business model for many.
Many of your regulators, is that something you'd be entertaining an approval on?
I will say all risk policies come up at a sort of regular cadence, just which would be like a bundled, right? That would be just all risk, few exclusions.
Okay, we have a couple minutes left. Any final thoughts or questions before we wrap up?
I'll just say that I do appreciate the interest in the paper and the invite to join you guys today. So thank you for having me, and Lori as well.
Yeah, thank you. I concur and really appreciate the interest in the paper and the opportunity to share with you and get very informative questions. So it's been very enjoyable and appreciate it.
Well, we thank you both for taking the time to meet with all of us here. And I just want to take a moment to thank my co-hosts as well in hosting our breakout sessions, Kelly, Jennifer, and Aaron. We had a pretty large group today, and making it in these small breakout sessions, I hope, helped to facilitate better conversation than in this large group. So thank you, everyone, for participating.
Thanks, Brenda.